If the Fed does not pivot like markets expect, would there be a black? Well, I don't know. I mean, there's no certainties. There's only probabilities. But I don't know that that would really create a black market or Black Monday, excuse me, type of event, because that's like a gradual process. I don't know. And what I mean by that is the market coming to that realization. I don't know if it happens all at once. I think it happens through the course of time. Now, could it set up if the Fed doesn't pivot and let's just say takes rates higher and higher and higher? Could that break something which would potentially be a Black Monday? Maybe, maybe it breaks. Maybe you have like a bond market blow up like the gilt market that crushes the pensions, that just causes this kind of feedback loop, doom loop, if you will, that creates a Monday of down, I don't know, 5,000 or something. It's definitely possible, but I don't know that there'd be a direct correlation that you could pin it on. Oh, hey, this Friday, everyone realized Fed isn't going to pivot, and therefore Monday, the market blows up. Smart people say the bottom in equities isn't in yet, but it is likely that stocks will stay at these levels nominally, but in real terms crash. Yeah, I mean, that's pretty much been my view on the housing market for since I started my YouTube channel, is that the prices were way, way, way too high, overinflated, and at some point in time, we've got to get back down to the trend line that we hit in 2012. But I always said, does it happen in nominal terms or when you adjust for inflation? And I said probably real terms. And so obviously I was a little early there, but that's not really what my channel's about. My channel's not about timing and doing all these things. It's really about just looking at long-term trends and recognizing the cracks in the system, because I don't think that CNBC does a very good job of that, obviously. So I try to take that upon myself to say, hey guys, here are some cracks that we need to be cognizant of, even if you're bullish, and let me explain to you why these are cracks. And hopefully in the process, people learn a little bit more about how the financial system actually works. But my point there is, yes, I think that you could see the stock market go down by, call it 10% nominally, but you combine that with a 10% inflation rate, and bam, you're down 20%. And then looking at that, going back to real estate, I did a video just, I think last week, where I pinpointed specific real estate markets like San Jose that are down almost 10% in the last 3 months in nominal terms. So let's just say they don't go down any further for the year, right? They only go down by 10 or 12% in nominal terms. Okay, but again, you got 10% inflation. You're down 22% in 1 year. So I remember, back in 2020, 21, just when I talk about this, people look at a chart of the housing market adjusted for inflation in 2012. Oh, George, that's impossible. That's never going to happen. Short supply, short supply, short supply. That's always like whenever I hear that, I just automatically assume that it's someone that just bought a house, or someone that their home equity is like 90% of their net worth, and it's very, very important to their ability to retire or something like that. And it's just them rationalizing just that prices are going to go up forever. So if you that cognitive dissonance is kicking in, and in order to help you sleep at night, you've got to conjure up some sort of reason why the housing market is just going to continue to go up to infinity and beyond, like Buzz Lightyear. Sure, yeah, that's going to be your trump card. Oh, supply. Then you just completely ignore the fact that demand can easily come down enough to where even if we do have short supply, now all of a sudden you go from a shortage to a surplus based on demand. And I would point right at the yield curve, right at the 3-month and 10-year. So, I mean, especially when you combine, let's assume you get a recession, and we're not going to have another GFC. We could have a let me take that back. We could have a global financial crisis, a global economic crisis, but it's not going to be exactly like it was in 2008. That's the probability that it's incredibly, incredibly low. So it might not revolve around real estate, but it's not like real estate won't be impacted. So let's just assume you've got, I mean, would it be outrageous, especially with the price declines that we've seen in some of these markets, to assume that prices go down, let's say overall this year by, and I mean this year, I'm talking about 2022, not the trailing 12 months. But this year to go down by maybe 5%, and then looking at the probability of recession, assuming we're not in one right now, is it just insane to think that prices could maybe go down by another 10% next year, and then maybe another 5%. Okay, well, now you're down 20% in nominal terms. Then I would ask you the same question about inflation. I mean, let's say it's running at 10% this year, just a round number. Okay, is it absolutely insane to think that it couldn't run at 10% on average over the next 3 years? So do the math. Do the math there. You're just in that little example I gave you, you're right back down to 2012, maybe even lower when you adjust for inflation, meaning the housing market goes down by 50%. I mean, when you say it like that, oh, it's the housing market go down by 50%, everyone just, oh, God, that's impossible. Then you just take a couple minutes and think it through. You're like, oh, yeah. Actually, doesn't seem so far-fetched. And taking it back to your question, Alex, I think the same would hold true for the stock market. And this is why on this channel or whenever I do these live streams, even in Rebel Capitalist Pro, I always encourage people just try not to worry about price direction. You know, if back in 2020 or even 2019, if I was worried about price direction of the housing market or this, I mean, who knows? You're trying to guess which way it's going. That's just unknowable. But what you can know is if the asset is cheap or if it's expensive. That is very knowable. So just base your investment decisions on cheap, expensive. Cheap buy, expensive sell. And don't try to worry about just, well, the price is, oh my gosh, but what if I sell and the price goes up by another 10% and I miss out on all those gains? And oh my gosh, what if I buy now and the price goes down by another 10%? You know, assuming it's cheap. It's a fool's errand. But what's unbelievable is that thinking is what occupies 99% of the mental bandwidth of retail investors. And to me, it just makes absolutely no sense.